Hello, this is Kathy Min, and I'm going to be speaking with you today about Chapter 4, Completing the Accounting Cycle. And on the screen, you'll notice that I have the financial statements. This is on page 214. And chapters 1 through 3, we have been dealing with the financial statements of income statement, statement of retained earnings, and the balance sheet. You've been learning how to write journal entries. And then in this chapter, it tells us we have come full circle. We now have created the first 3 financial statements. And so what I need you to think about now is that this is at the end of the year. This company in particular, it didn't come into existence until November the 1st. So that's why they're only showing 2 months on these financial statements. This particular company we were following just came into existence. But here's the deal. It's at the end of the calendar year. That's the year they've adopted. So they're going to show that they only have 2 months for this year. Okay? Now, that's really not important to you, but here's some things that are. We have to prepare the financial statements in a certain order. Income statement is first, then the statement of retained earnings is second. Balance sheet is going to be third. On the income statement, well, both of these that you see here on the screen, the income statement and the statement of retained earnings, their headings are always going to, in this instance it says 2 months ended December 31st. It could say 1 month ended, it could say quarter ended, it could say year ended, but it's always going to be for like a wide time span. When we scroll down and we look at the balance sheet, you'll notice it is for a particular day. On this day, December 31st, our balance in cash was $12,200, accounts receivable $1,800. Balance sheet tells you that on a particular day. So it is the financial statement for a particular day, and the others are going to be for a time frame. Okay, if we go back up to the income statement, this is the first financial statement you prepare. It is going to have your revenue accounts and your expense accounts, and then the difference between those two is going to be your net income or your net loss. You have to prepare these first, this particular statement first, because the number that you derive from this, it is used over in the statement of retained earnings. Okay, so here we have found that we have $17,500 of revenue and then $8,950 of expenses. I want to point out to you that these numbers right here, these are the total expenses. If you add them all up, it comes out to be this number, the $8,950. These two columns, this is not a debit column, this is not a credit column. In financial statements, they summarize the information, which is what this furthest column to the right does. It summarizes. And if you want to see how did we come up with $8,950 here for expenses, then you go to the left. The further left you go, the more information you'll have. So that's the way that works. Okay, so we take net income. We're starting over here with statement of retained earnings. You see a 0 here. The reason it's a 0 is because the company just started on November the 1st. If this company had begun earlier than that, we would have a beginning balance here for retained earnings. But we don't, because it's a new company. Okay, so we bring in the net income and we add it to the 0, and obviously we get this number, and then we're subtracting dividends and we come up with $3,550. That is our ending retained earnings number. Just so you understand, retained earnings is literally what it sounds like. Here's what we've made, the $8,550 in net income. We have distributed $5,000 of that in dividends to our stockholder. We have retained this to use in the business. On financial statements, an account will only be used one time. Service revenue, the only place you're going to see a revenue or an expense account will be on the income statement. Retained earnings is the one exception to this. There's always an exception, but it is the one. You'll find it on the statement of retained earnings, and then the reason balance sheet is prepared third is because we have to have that retained earnings number. So you take your updated retained earnings number and you use it here in your balance sheet. You'll notice that the balance sheet is like the accounting equation. Assets equal liability plus stockholders' equity. So you've got two $113,550 balances. These are balance sheet accounts, and something I'd like to point out to you, we're going to be using closing entries here in a few minutes, and what you need to know about that is that these are considered permanent or real accounts. Their balances are going to roll over into the next year, as you would expect. On December 31st, this company has $12,200 of cash, and yes, on January the 1st, we would expect that balance would be there in the next year. These accounts will not lose their balances. They're going to roll on over into the next year. When we begin to close our accounts, what we're closing are going to be income statement accounts and dividends. Those accounts, and when I say close, we're going to take their balance and close it to a zero. And so in the new year, they're going to start out with a zero balance, and then during the year we'll be adding to that expense, and then at the end of 2015, now we'll be able to see how much income and expense we had for that year. So we will be working on closing those, and for right now, this is what I wanted to talk with you about the financial statements. We're getting close to the end of an accounting cycle. We create these financial statements, and then we will do closing entries, and then the very last thing we do is a post-closing trial balance.